Good day, and welcome to this special report on the recent collapse of Silicon Valley Bank. In the world of finance, nothing strikes fear in the hearts of investors and consumers quite like a bank collapse. When a bank fails, it can have far-reaching consequences, not only for its customers and shareholders but also for the broader economy. In this video, we'll take a closer look at the impacts of the Silicon Valley Bank collapse and what it could mean for the financial system as a whole. What is SVB? Silicon Valley Bank, also known as SVB, was the 16th biggest bank in the United States. It had more than $200 billion in assets and $340 million of client funds at the end 2022. Its primary goal was to help fast-growing startups in tech and healthcare with their finances. SVB was actually the bank of choice of nearly half of all US-backed venture-backed startups. What happened to SVB? Rising interest rates are the first step in this story. The Federal Reserve aggressively raised interest rates to the highest levels since 2008, despite persistently high inflation and a better economy than expected. Many of SVB's clients are dominated by high growth, but often losing-making businesses that require a lot of cash to continue their operations. Rising rates caused venture capital to dry up, making it more costly for clients to borrow money. Clients were forced to tap into their savings. SVB was left struggling to keep up the pace of withdrawals and deposits. It sold a portion of its investment portfolio to plug the gap. It sold it for $1.8 billion, but the problem was that it had to because it included bonds that had experienced significant losses due to lower yields and higher interest rates. These bonds would have been profitable if they had been held to maturity. SVB was in a difficult spot due to the fact that over half its assets were in its investment portfolio. This left it with less cash and fewer options than banks with a more diverse asset base. SVB decided to convert deposits that customers can redeem on request for held-to-maturity bonds. This was due to the fact that SVB had not engaged in any interest rate hedging. It was forced to sell assets at a loss due to the withdrawal of more deposits. SVB Financial announced that it would raise $2.25 billion in equity to boost its balance sheet on Wednesday, March 8. This set off a siren about the bank's financial instability, and some prominent venture capitalists told the businesses they invested in to stop pulling money from SVB. This led to the equity sale failing and subsequent attempts to find a buyer going sour. SVB was shut down by regulators Friday, March 10. This is the second largest bank failure in US history and the biggest collapse since the financial crisis. What now? SVB has been transferred to the Federal Deposit Insurance Corporation. This independent agency insures deposits at US banks and is responsible for maintaining financial stability. SVB Financial has now lost control of the bank. SVB's assets were transferred by the FDIC to a new bank called the Deposit Insurance National Bank of Santa Clara. Clients will have access to their money immediately, which gave some security before Monday's opening. Other banks can now borrow more easily from the Federal Reserve to provide funds for impacted companies. This also provides a source of emergency funding. Now, the goal is to find a buyer who can acquire SVB's assets. The auction that took place over the weekend proved ineffective. According to Bloomberg, Apollo Global Management, the largest alternative asset manager in the world, was reported to be one of the potential suitors for SVB's loan books. Although the total loan book is worth more than $76 billion, it's not clear if potential buyers would be interested in just a portion of it. The FDIC will repay insured deposits to clients, up to a limit, if there is no buyer. However, this could eventually lead to some clients receiving less than what they invested. All client funds, whether insured or uninsured, are currently being made available in full. This is important considering that 89% of SVB deposits aren't insured. Companies can withdraw or move their funds as needed. Reports suggest that larger banks, which are considered to be more secure, have received a lot of requests to transfer funds to them. Fears of contagion after SVB collapsed. The collapse of SVB raised new concerns about the financial system's health and could lead to similar fates for other banks. This situation was made worse by the fact that Signature Bank was also closed by regulators on Sunday. They introduced similar guarantees to depositors concerned. After SVB collapsed on Friday, the bank was faced with a flood of withdrawals. This was shortly after the crypto-friendly bank Silvergate Capital declared it would be ceasing operations and going into voluntary liquidation. Banks are generally in a better financial position than they were during the last financial crisis. They are also not in the same situation as SVB, which was heavily exposed to a cash-hungry, fast-growing clientele. However, an unexpected collapse could lead to a self-fulfilling crisis if there is a bank run that causes panicked consumers or businesses to withdraw their cash from other banks. This would leave the entire sector short of cash. This is why regulators and central banks have acted so quickly and decisively to calm nerves over this weekend. If there is a run, small regional banks could be negatively affected by the SVB crash. People will shift to larger, more financially secure banks. These fears are evident in the market, as First Republic and Western Alliance plunged Monday, hitting their lowest levels in more than a decade. This could lead to the possibility of a market problem that is not limited to a small segment of the market becoming a larger one. Today, we are seeing both banks recover in pre-market trading. Another concern is the impact it will have on finance for vital industries like tech, healthcare, and life sciences. It was avoided that the initial concern that thousands of businesses would not be able to pay their wages and bills this week would lead to an even greater spillover to the wider economy. Still, markets will be wary about the future of funding for startups, which can often fall in the high-risk, high-reward category and find it difficult to secure cash because they are unproven. HSBC saves UK arm SVB. We learned that HSBC had stepped in to save the UK arm SVB just hours before the London Stock Exchange opened Monday morning. The UK arm has approximately PS6, 7 billion in deposits, and PS5, 5 billion loans. The Bank of England spent the weekend working to find a solution to ensure that its 3,300 clients, mostly small, would have access to their funds as usual before the markets opened. However, it is not yet completely cured of the nervousness. THG and Moonpig, among others, issued statements today to assure investors that they are not going to be affected by the situation. What does the SVB crash signify for investors? Investors in SVB Financial are not happy with this news. Reuters was told by a senior US Treasury official that while depositors were being secured, the bank wasn't being bailed. According to the official, the new policies to protect depositors were introduced this weekend and will wipe out equity investors as well as bondholders in SVB. What impact will the collapse of SVB have on interest rates? SVB's collapse has brought to light the negative impact of Fed's aggressive interest rate hikes on certain parts of the economy. The market was expecting another 50 bits per second rate increase when the Fed met later in March. However, the odds of a 25 bits per second rise have changed quickly following Friday's collapse of SVB. The market believes that the Fed could choose to increase rates slightly less than it did in the past. Analysts also suggested that rates might be left at the current level before rising again in May. This is to make sure that other financial systems don't suffer the same fate as SVB. As we've seen in this report, the collapse of a Silicon Valley bank can have significant implications, not only for the customers and shareholders of the bank in question but also for the broader economy. While the impacts of a bank collapse can be severe, there are steps that regulators and policymakers can take to mitigate the damage and prevent similar events from occurring in the future. We hope that this report has given you a better understanding of the implications of a bank collapse and the importance of a strong and stable financial system. Thank you for watching.